Most companies shrink because they're failing. AngioDynamics shrank on purpose. It sold off its slow, low-margin product lines, bet the company on 3 high-growth platforms, and this year, the bet started paying. Revenue re-accelerated, cash flow flipped positive, and the stock jumped 13% in a single day. This is what the actual SEC filing shows. Start with the shape of revenue. $316 million in fiscal 2022, $339 million the next year. Then AngioDynamics deliberately sold its dialysis and catheter businesses, and revenue fell for 2 straight years, down to $292 million. Fiscal 2026 is the payoff year. Sales came back up 9.5% to $320 million, and this time every dollar comes from businesses the company actually wants to own. Here's where the growth lives. The med tech segment, that's the Orion atherectomy laser, the AlphaVac and AngioVac clot removal systems, and the NanoKnife tumor ablation platform, grew 18.4% to $150 million. It's now 47% of the company, up from roughly 22% in fiscal 2020. The legacy med device business grew just 2.5%, but that's its job. It's the steady cash engine that funds everything else. 7 straight quarters of double-digit medtech growth and 20 straight for Orion. Now the single most striking number in the filing. NanoKnife sales grew 64.5% in the fourth quarter. Probes up 47%. Capital equipment up 132.5%. The product didn't suddenly get better. It suddenly got paid for. New billing codes for the procedure went live in January, and Medicare coverage followed in July. Here's the sequence that unlocked it. In May, 2-year data from the PRESERVE trial showed durable prostate cancer outcomes. 97% of patients still had PSA below baseline, with no new treatment failures in year 2. In January, Category 1 CPT codes for the procedure became active. Effective. July 5th, a Medicare contractor finalized coverage for prostate and liver. And next, the FDA cleared a study taking NanoKnife into enlarged prostate treatment. A market management says dwarfs prostate cancer. The margin math is the whole thesis. MedTech gross margin 63.6%. Med device 46.7%. So every dollar of sales that shifts toward MedTech carries roughly 17 extra points of gross margin. That's how total gross margin expanded to 54.6%, even while tariffs took away about 1.5 points. And starting next year, an outsourced manufacturing plan is guided to add $15 million in annual cost savings. Put it together, and the profitability line finally moved. Adjusted EBITDA came in at $13.2 million, up 73% from $7.6 million the year before. Operating cash flow swung $13 million to positive, and the balance sheet is clean. $53.9 million in cash, 0 debt, and an untouched credit line. Now the reality check, because this is still a money-losing company on paper. The GAAP net loss was $36.7 million, or 88 cents a share, actually wider than last year. Between that loss and the positive adjusted number sits $23 million of depreciation and amortization, $14 million of stock compensation, and nearly $18 million of restructuring costs, mostly plant closures. The bull case says those charges sunset as the restructuring finishes this year. The honest read is that profitability here is still an adjusted concept. Management's guide for fiscal 2027. Revenue of $336 to $341 million, up 5 to 6.5%. MedTech growing 12 to 15%, which would push it past half the company. Gross margin holding at 54 to 55%. Adjusted EBITDA of $13 to $16 million, and tariffs assumed broadly similar to this year. So, what is it worth? At around $14.50, the market cap is roughly $600 million, about 1.7 times sales. A 5-year discounted cash flow gives a wide range. A bear case near $4 if growth stalls. A base case around 10 if the company simply hits its guide and reaches a 10% EBITDA margin. A bull case near 18.5. And if MedTech eventually gets valued like a growth MedTech asset. A sum of the parts points to $20 to $29. Today's price sits above the base case, so the market is already paying for clean execution. These are implied values under stated assumptions, not a price target, and not investment advice. What could break the story? The CEO who ran this transformation is retiring, with a successor expected only in the first half of fiscal 2027. Medicare coverage for NanoKnife. So far comes from a single regional contractor, and it has to spread. Tariffs cost $4.8 million this year, and guidance assumes the same again. And in clot removal, AngioDynamics is fighting Boston Scientific, Penumbra and Stryker, giants with far deeper pockets. Against that, 7 straight double-digit quarters, a debt-free balance sheet, and a $15 million cost tailwind arriving next year. The bottom line, fiscal 2026 is the first year the shrink to grow strategy produced a clean, verifiable result. What to watch from here? Whether medtech crosses half of revenue, whether NanoKnife coverage spreads beyond one contractor, whether the GAAP loss actually narrows once restructuring ends, and who takes the corner office. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description.